Hello. So today we're going to talk about statistics related to the presidential election. Over the past few months, I've been studying how the stock market moves around the US presidential elections, and I will now try to share what I have learned. I've also coded a few algorithms based on this study, which you will receive today and that you can use yourselves. In total, there are 10 different algorithms. One goal of this presentation is that you afterward will be able to make better trades before the election, during the election, and after the election. If you want to look at the details of this study, I published a lengthy post about everything I'm covering today on our website. The website address is prorealalgos.com/USA. If you would like me to dig up any additional statistics, feel free to email me and I can run a check for you. So, what am I doing here? Well, I'm here in my capacity as a quantitative trader and algo developer. I run a company called ProRealAlgos. We develop trading algorithms, indicators, and other tools. We also conduct studies like the one I will present today. I have a bit of an obsession with statistics, especially statistics related to the stock market. And why am I so obsessed with it? Well, because I and many others have realized that the stock market often follow its historical patterns, its own historical patterns. And that means that we as traders will do well to trade according to the historical patterns that we can find. I want to mention that this presentation should not be considered financial advice. One of the most important things to remember is that past performance is no guarantee of future results. I have found patterns in how the market has historically behaved around the presidential elections, but this is not black and white, and statistics cannot predict the future. It's important that you view these patterns and statistics as probabilities. For example, if I say that the stock market historically risen 75% of all presidential election weeks, it doesn't mean that the market regularly falls every fourth election week. It simply means that 1 in 4 election weeks on average has been negative over the time period that I've looked at. So this is really like common sense when you think about it, but it's very easy for the brain to draw its own conclusions, more or less unconsciously, about things that the statistics might not actually say anything about. I thought I would start by throwing out a quick tip. You could call it a teaser, if you will. So historically, it's been a very good idea to go long on the Friday, 1.5 weeks before the election day, which is tomorrow, October 25th. You will have a chance then to catch a historically strong period, and after this presentation, you will understand why. You will also get to know the most optimal moment to exit that trade. First, I would like to mention a few things that are important to know about the study, as well as US presidential elections in general. Number one, the presidential election is always held on the Tuesday after the first Monday in November. Number two, most of the statistics in this study are from 1932 up to the present day. So this covers 23 different presidential elections. And it also means that we are not including the stock market crash of 1929, which gives slightly higher return figures than what you might be used to hearing in contexts like this. If the data is from a different period than 1932, I will explicitly say that. Number three, the statistics presented are from the S&P500 index and no other index, so it may not necessarily be representative of how the full stock market moves in connection to the US presidential elections. Number four, the statistics include dividends but exclude transaction fees. Number five, 23 presidential elections are not a very large data set, so we should be a bit cautious about drawing conclusions from such a small amount of data. Number six, up until 1980, the stock market was closed on election day. So this applies to the first 13 presidential elections in this period. So this makes it somewhat harder to interpret the historical pattern specifically during the election week, but more on that later. I would like to start with an interesting curiosity because it's such a strong pattern. So this is not about predicting the stock market movements based on the presidential election, but the reverse, where the stock market movements can predict the outcome of the presidential election. So here is the statistic. If the S&P500 is up from 3 months before the election until the election day, history shows that 87% of the time the incumbent party has retained power, and this data is from the 1928 election up until the 2020 election. So if you want to bet on the Democrats retaining its power, you at least have good historical data backing you. When I made this presentation, we were up around 10% since August 5th, and the presidential election is on November 5th, so the odds are quite good that we will be in positive territory in that 3-month period. The odds on the betting sites will give you around double your money or even a bit more than that. And this is the first bet that I will be taking before the election. If SP500 is still in positive territory on November 4th, I will be betting on the Democrats winning the election. And now to the study. I'm going to show you how the stock market moves from long to short term in relation to the presidential election. We'll first look at it on a monthly basis, and then we will dig into weeks and finally into days. Next, we will look at 5 trading strategies that I personally use and see how they perform over a presidential cycle. And finally, we will examine 3 day trading strategies and see if we can spot any pattern in how they perform in relation to the US presidential election. Throughout the presentation, I will also mention which position I myself will take based on the edges that I have identified. If we start with the long term, meaning months and years, here is the first chart. In this, I have plotted how the SP500 has moved 24 months before the election up until 24 months after the election. Each line here represents one of the 23 presidential elections held since 1932. Each data point represents a month, and the middle point here, marked here, is the monthly close in November of the election year. Here, for an example, we have the 2020 election with the corona dip about 9 months before the presidential election. And here we have the 2008 election and the financial crisis. If we were to look at an average of these 23 presidential elections, the curve looks like this. And if we zoom in a bit, we can see a bit more clearly how the stock market on average moves over an entire presidential election cycle. So from the close of the last trading day in October and 12 months forward, we have an average return of 10.54%. After that comes the 12-month period with the lowest return at 6.58%. Then comes the best period, which is called year 3, with a return of 15.81%. And then the 12 months before the election with a return of 10.37%. Once again, these figures might be higher than what you have heard before, but this is the S&P 500 with dividends included and the 1929 stock market crash excluded. Also, please note that this is not from January 1st to January 1st, but from the close of the last trading day in October to the close of the last trading day in October the following year. Here we see the same return figures in the red bars. The blue bars shows the average return of only the last 5 presidential elections. And here we can see that this pattern is even more pronounced, with year 3 being the strongest year and year 2 being the weakest year. The average annual return is 10.82%. Here we see a bar chart month by month. The red line shows the average monthly return of the S&P 500. So you can easily see here which months the stock market outperforms the average. And as mentioned, you can study all these images in more detail on our website. Here we have all months in a table. November of year 1 is the month where the presidential election is held. The value shown in each and every one of these cells represents the average return from the close of the previous month to the close of the current month. So 1.04% here is the average return from the last trading day in October to the last trading day in November of year 1. And when you study this table a bit more closely, you can see that we have an especially strong period from September of year 2 to December of year 4. It's this period and this moment that I have built the first algorithm to capture. That's nearly 23% over 16 months. So here we have the code for the trading algorithm. It simply enters a long trade at the end of September in year 2 and closes that position at the end of December in year 4. It's just 10 lines of code, and you can run this algorithm yourself in ProRealTime, which is the trading platform I personally use to develop and execute my algorithms. ProRealTime is available through IG, so you can go to ig.com and download it there. And if you want the code, it's also available on our website under the link prorealalgos.com/USA. It might seem a bit excessive, though, to automate a strategy that enters just one trade every presidential cycle, but I'm just mainly showing this to show you how easy it is to automate your trading. Let's dig into lower time frames. Here we have a weekly chart where each data point represents a week. So here we can see how the stock market moves from 52 weeks before the election to 52 weeks after the election. The midpoint here represents the weekly close during the actual election week, meaning the close on the Friday. Here we have the 2020 election again, with the corona dip around 33 weeks before the election. And here we have the 2008 election, right in the middle of the financial crisis. And if we were to look at an average of these 23 presidential elections, the curve looked like this. And if we zoom in a bit, we can get a clearer view of how it looks, but we can actually zoom in a bit further. So here we have the average return in a line chart, and below that we have the same data in a bar chart. But here we are only looking at 25 weeks before the election until 25 weeks after the election. So if we were to try to capture two historical strong periods, we can see the first strong period here. The 14 weeks that are now highlighted have historically given a return of 7.18%. The next strong period begins tomorrow on October 25th, and that period looks like this. So this second period isn't as strong, but it's interesting because it starts tomorrow. We don't have to wait 3.5 years. So the period starts tomorrow and lasts until 8 weeks after the election. So it's a total period of 10 weeks with an average gain of 3.89%. The exit is to be made at the beginning of January. I've also built a code for this strategy. This algorithm goes long during the second period I just showed you, starting tomorrow and closing in January. Again, it's only 10 lines of code, and if you want the code, it's available on our website. The result in this backtest, which you can see here on the right, is from 1950 until today, not from 1932. It shows an average return of 4.73% over the past 74 years, compared to 3.89% over the past 92 years. So this means that the edge has actually gotten stronger over time, and you can also see here in the chart that the edge has been at its strongest in the last 3 trades. i.e. the last 3 elections. And this is why this is the second bet I will be making related to the presidential election. I will take a long position tomorrow and close that position in 10 weeks on Friday, January 3rd. Now let's dig into even lower time frames. Here we have a daily chart where each data point represents a day, showing how the stock market has moved from 30 days before the election until 30 days after the elections. So now we're talking about trading days, days where the stock market is open and not ordinary weekdays. The midpoint here is the close of the presidential election day, which is on Tuesdays. And here we have the 2020 election, and here we have the 2008 election. If we zoom in and look how the stock market on average has moved up until the Monday before the election day, it looks like this. We can see that there is a strong period starting around 7 days before the actual election day. If we look at the presidential election week itself, it has played out a bit differently in various presidential elections. So up until 1980, the stock market was closed on the election day, but since then it has been open on the election day. So here we have a bar chart where we have Monday, Tuesday, Wednesday, Thursday, and Friday. Tuesday is the election day. The dark blue bars here represents all elections from 1932 until 1980 with no return on election day, and the red bars return shows all the elections since then, and the gray bars are the average of all 23 elections. So here we see a few noteworthy things that we can use when trading around the election day. Number one is that Wednesday stands out as clearly negative, meaning that it has historically been a good idea to exit any long trades before the Wednesday. So for the earlier elections, that would have been on the close of Monday, but since then, for the later elections, it would have been the close on the actual election day. One thing that stands out is that in the elections where the market was closed on election day, Thursday has been very strong, while it hasn't been that case in years where the market was open on election day. So in this upcoming election in 2 weeks, the market will be open on election day, so I think you should act according to the red bars. If you're considering taking a short trade, let's say for just a day, it has historically been a good idea to do so at the close of the election day. You can also use this data if you're day trading and want to decide which day to have a long bias and which day to have a short bias. And if we look at the period after the election, it looks like this. So this is from the Wednesday after election day onward. On average, across all presidential elections, Thursday has shown a positive return, but as I mentioned in the last slide, this hasn't been the case in the last 10 elections. After Thursday, we see a few days where the S&P500 tends to go down. We also see that there isn't much momentum in the stock market during the 3 weeks after the election week, which is why it's a good idea to exit any long trade on the actual election day. So here we have a comprehensive chart with all the presidential elections. Remember that it's a bit unclean since the election week has differed between the election years, but we can still see that we have a quite strong period here starting from 7 days prior to the election day. So where are we today? Well, today we are at the first red dot here. So historically, it's been a good idea to enter a long trade at the second red dot here. So for the 2024 election, that's tomorrow at the close, i.e. Friday, October 25th. And if you remember, this is the exact same golden entry opportunity that we saw when we looked at the weekly chart. The difference here is that this trade will be much shorter. Instead of holding the position for 10 weeks, we will exit it here at the close of the election day. So this trade captures a period that has historically delivered a return of 2.41%. The trade lasts for 7 trading days, and I will actually take both of these trades. So I will enter 2 long positions tomorrow. Tomorrow is October 25th, and I will exit one of the positions on election day, and the other position I will exit on Friday, January 3rd. I thought we could talk a little bit about VIX. VIX is, for you who aren't familiar with it, a volatility index that measures the market volatility and fear. Volatility refers to how much the stock market moves up and down, where a high value means that the market is moving a lot and a low value means that the market is just moving a little. This is probably most interesting for you who are day trading. And here we have the 2020 election again, with one of the highest VIX readings ever. That was during the COVID pandemic in March 2020. And here we have the 2008 election, where the volatility spiked sharply just 2 months before the election and then gradually declined again. And if we were to look at an average of the 8 presidential elections that we have had since VIX was created in 1990, it looks like this. And if we zoom in a bit, it looks like this. We are at the red dot now, and that is October before the election. We can see that the VIX index peaks here with a high volatility, and then it drastically decreases in November. And then a few months of gradual increase again until the end of February, where VIX will again drop sharply, and it bottoms out here in July around. So here we have a 6-month moving average of VIX. We see a declining volatility after the presidential election, and around the summer of the year after the election, volatility begins to rise again up until 24 months after the election. If we look at the volatility year by year, it's also clear that the volatility is lowest on average on year 1, then it increases up to year 4, and then it drops again in year 1, right after the presidential election. If we zoom in on VIX at the daily level, it looks like this. The black line here represents how VIX moves on average from 30 days before to 30 days after the presidential election. And here we are now. Historically, we have 2 days of increasing volatility before we are making a high here, and we stay high until it quickly drops during the election week. Let's take a look at a couple of swing trading strategies and see how they perform relative to the election. These are strategies that I have personally myself been using. They are simple with just a few conditions for entry and exit. I have backtested them in per real time, and in per real time I only have access to data from 1984 to the present. So the results that I will be presenting now are only for the last 40 years, which is 10 presidential elections. So the average length of the trades of these algos are just a few days. All strategies are long-only strategies. They have a maximum of 3 entry conditions and a maximum of 1 exit conditions. I won't go through all of them in detail, but we can look at just what the first one is doing. So the first strategy, that is called long-only MA8, is going long if S&P500 is above the moving average of 200, but the today's close is below the moving average of 8. So in addition to that, we also have to make sure that the 2 of the last 3 days have been negative. We exit the trade when the price again crosses through the moving average of 8. The code and conditions for all of these strategies are available as everything else on our website. There you will also find more detailed descriptions on how these strategies operate. Here's how the 5 strategies have performed year by year. In a simplified way, we could say that the returns follow the pattern we see on the annual level of the S&P 500, where year 1 and year 3 are the strongest, and year 2 is the weakest. Here we have the results broken down by which year it is in the presidential cycle. The strongest year across all strategies is year 1, followed by year 3, followed by year 4, and finally year 2. 5 of the strategies perform best in year 1. So what conclusions can we draw from this? Well, I could say that these strategies, which are long-only strategies, clearly performs better in the years of the presidential election cycle that have the highest returns. I also find it interesting that 3 out of 5 strategies perform best in year 1. I wouldn't say that it's wrong to include or exclude strategies based on which year we are in now. You could also add conditions to the code, of course, to trade with larger size in the years where the strategy has performed better. Now we're going to look at some day trading strategies. These strategies take 1 to 3 trades a day and are much more complex. They all operate on a 10-minute time frame, and we don't have time to go through all the conditions now, but as mentioned, you can find everything on our website. But I want to show you how they perform relative to the presidential election. So here we have the 3 strategies year by year. On a 10-minute time frame, we only have access to about 15 years of data, so that is from 2009 until today. An interesting observation is that all 3 strategies combined perform better during the years in the presidential election cycle where the average return is low. I've also noticed a correlation with the VIX on a monthly level, and I would dare to say that these day trading strategies perform better when the volatility is increasing. So not just only when the volatility is high, but when the volatility is increasing. So this is at least a direct inverse pattern compared to our swing trading strategies, where the historically weakest period, year 2, is the strongest year for our day trading strategies, and where the historically strongest period, year 3, is the weakest for our day trading strategies. Okay, so in conclusion, how will I be positioned around the election, and what strategies will I be using? Well, I've already mentioned 3 bets that I will take. You can see them all at the top of the slide. Number 1, the day before the presidential election, I will bet that the Democrats win if the S&P 500 is still up during that 3-month period. Number 2, I will go long at close tomorrow, and I will exit that trade on January 3rd. Number 3, I will take another long trade tomorrow, but that trade I will close on the actual election day. And as number 4, I will start 3 out of 5 swing trading strategies and let them trade for me automatically from November 1st and 12 months onward. And the 3 strategies that I will start are long MA8, 3 days down, and average true range. The reason that I will start these 3 strategies is that they clearly outperform during the first year of the presidential election cycle. Regarding the day trading strategies, I would first like to refine them a little bit before making any decisions. I also need to add some stop losses and other features before starting them. And lastly, if you want to follow what I'm doing, don't forget about September 2026. That is where I will enter a long trade for 16 months and capture a movement of 23%.